Hello, this is a quick takeaway or summary of the topics or concepts encountered in our first week here in financial management class. In short, this is our cheat sheet for week 1. Of all the concepts you have encountered in our materials, these are the ones I want you to remember. Starting with our first slide. Okay, as of this point, you should already know what is the meaning of finance. It has a lot of meanings. Sometimes it refers to the process of sourcing out money. Sometimes we also use this term to refer to investments. Okay, and sometimes we're just referring to money. Now here in our subject, every time we use the term finance, we are simply referring to a field or a subject, okay, that is related to financial resources. Also, okay, you have encountered the term management. Well, management, this is the art and science of the basic management functions, okay, which are your planning, leading, organizing, controlling, and directing organizational resources in order to achieve a common goal. Now, if you try to read other textbooks, okay, it's also included in the basic functions of management. Okay, what is included is your decision making. And this is one of the most unique functions of management because decision making is integrated with the other functions, which means you can already make decisions while you are still in the planning stage or in the organizing stage or in the directing stage. Now take note, okay, that we mentioned organizational resources. Now our basic financial resources, okay, is also known as your 4Ms. What is 4Ms? Okay, 4 MIT students and production management students, okay, if you remember your Ishikawa diagram, these are composed of your methods, manpower, materials, and your machines. Now, when we say machines or machineries, we're not just talking about your actual machines used in business, but this refers to all tangible machineries and assets used in the business process. This could mean your property, any plant and equipment, and your land, okay, and other machineries that is used in your business process. Now, if you have your tangible assets as represented by machineries, you also have your intangible assets or intangible part of the business process, which is known as your methods. This could refer to, let's say, your policies and your guidelines in your business process. It could also mean to the softwares, okay, the processes that are installed inside our machineries. Also, we have your manpower, which is self-explanatory, and your materials, your 4M, okay, which of course represents not just your raw materials, but all inputs needed in our business process. And sometimes what makes this confusing is that if there are services needed as an input in our business process, okay, they are referred to as materials. And sometimes they're also referred to as manpower. Okay, so that's a gray area on that part, no? And also from the definition, we mentioned ayan, to achieve a common goal. Later, we will be talking about the common goals of an organization. Now, if you try to put these things together, financial management, this is basically the art and science of planning, leading, organizing, controlling, and directing financial resources to achieve a common goal. Ayan. On the side, okay, you should also be exposed to the different areas, no, and opportunities in finance. Now, there are different jobs, no, related to finance, but if you can categorize them, you can have two categories. Okay, so the first category will be those who are involved in financial services. Okay, And the second one will be your managerial finance. So if you are employed in an entity, okay, providing financial services, that is what we call managerial finance. But if you are, let's say, providing financial services, okay, as a consultant, okay, or as an external entity, that is now what we call financial services. We also have the different legal forms of business. Now, when we talk about forms of business, you have the forms of business as to operations. Okay, what are these forms of business as to operations? You have your sole proprietorship. No, I'm sorry. You have your servicing. Okay, when you are providing services, you have your merchandising if you are buying and selling your merchandise or your outputs, and you have manufacturing if you are going to manufacture your own goods. Now, you also have your forms of services, okay, based on ownership. And these are the legal forms of business. You have sole proprietorship, okay, if you have one owner. You have partnership if there are two or more. And you have corporation, which is very similar to partnership, but, well, it has more legalities. Okay, it is harder to form. It is based on contract. Okay, and it's more complicated as compared to partnership because there are a lot of legal requirements. Okay, that's number one. And when it comes to operations, okay, there are some rights available to a stockholder which is not available to partnership. Now, on that part, well, that will be covered by a different subject. As of this point, I just want you to know that when it comes to legal forms of business as to ownership, when there's one owner, you have the sole proprietorship. If there's two or more, you have partnership and corporation, which is more complicated. You have your corporation. Most of the time, when we talk about organization here in financial management, we are referring to corporations. Now, that doesn't mean that financial management is not applicable to sole proprietorship and partnership. It's just that most of the time, those who employ the services of a financial manager or those that needs financial management applications, most of the time these are the corporations. Next, as of this point, you should also understand, no, the different entities in a corporate organization. First, you have the owners. We call them stockholders. For a non-stock, non-profit organization, we don't call them stockholders. Instead, we call them members. Now, these stockholders or members for a non-stock non-profit organization, they're going to select amongst themselves who's going to represent them in the day-to-day decision making of the entity. And these are now the board of directors. Of course, okay, this board of directors, they're going to choose, appoint, or maybe hire, okay, who's going to be the chief executive officer. And that is now the president. And under the president, you have the different vice presidents. Okay, now it really depends on how vast your operation is. Okay, sometimes you can have one or two vice presidents. Okay, there are some organizations they have as much as eight vice presidents. Okay, now, okay, what is important to us will be the vice president for finance, which is also known as your CFO or your chief financial officer. Now, your chief financial officer will have how do I say this? Two sidekicks, okay, two subordinates, okay, or two assistants, okay. We call them the treasurer and the controller. The treasurer is the one that decides, okay, where the money will come from, how it will be used, and where we are going to put our money or financial resources, while the controller will be the one who's going to record what the treasurer is doing. Okay? Sometimes, okay, we see organizations, okay, where there's only one entity performing both functions. That's okay, but when it comes to control of assets, it is ideal that these functions should be performed by separate entities. Now, in other entities, especially your non-profit organization, your controller is known as your comptroller, like in a computer, COMP. Okay, it's the same, no? Actually, your controller is also known as your chief accountant. The same with comptroller. Now, what's the difference of a controller and a comptroller? A comptroller, okay, is actually the chief accountant of a not-for-profit organization, while a controller is the chief accountant for a profit-oriented entity. And then under your vice presidents, you now have the different managers. Okay po? Now you have your financial management and other fields. Okay, financial management is actually related to a lot of fields most of the time. Okay, it is related to economics and accounting. Why economics? Well, because most of the concepts used in financial management is based on economic framework, no? Like let's say marginal analysis, okay, differential analysis. You also have accounting, okay. Why is financial management always related to accounting? Well, as we all know, okay, financial management or finance is the lifeblood of business, but the language of finance is accounting. Okay, so it says here that decisions in financial management is based on information that is processed by accounting. So it's really hard to be knowledgeable in finance if we don't have any background in accounting. That's why even if our subject is titled financial management, there will be a lot of accounting concepts that we have to discuss. What's the difference of accounting and financial management? Okay, well, accounting is based on accrual basis, while financial management is based on cash basis. What does this mean? When we say cash basis, your revenues are recorded once they are received, while expenses, they will be recorded or recognized once they are paid. For accrual basis, okay, revenues are recorded or recognized when they are earned, regardless of when they are received. What does this mean? Okay, even if, for example, you already received, let's say, 12,000 pesos representing rent for 2 months. So you receive that in advance coming from your tenants. What you can only record for your revenue is only for the current month, even if the other months are already received in advance. Or, for example, one of your tenants promised to pay you after 6 months. Okay? Now, even if the current month and the succeeding months are not yet collected under the accrual basis of accounting, because you have already earned these revenues, then you have to record them. The same with expenses, whether they are paid in advance, okay, or whether they are not yet paid, as long as they are already incurred under the accrual basis of accounting, they have to be recognized. Okay. Now, also under accounting, okay, the focus is more on the collection and presentation of data. While in financial management, the focus is on decision making. That's why under accounting, okay, most of the time in other books, it's it's termed as historical basis, a field which has a historical basis. Why? We only account for transactions that have already transpired. Okay? They have already manifested. Yun. While for financial management, okay, it is future oriented. Why? Because it's focused on decision making. We don't make decisions for past events. Like, for example, what will you eat yesterday? Or what are you going to wear last night? Instead, we make decisions for future events. For accounting, it's historical basis because we don't record transactions that hasn't happened yet. Okay po? Now let's continue. For accounting, okay, this is done by the controller. For financial management, okay, this is performed by the treasurer. For accounting, we have these generally accepted accounting principles. This is actually a set of standards used, okay, from analyzing, measuring up to the presentation of transactions. Okay, and if in accounting you were not able to follow all these standards, then your output will be considered as incorrect. In accounting, it's black or white. If it's not correct, definitely it's wrong. In financial management, in some books, it states that there are no standards to follow. Actually, there are standards, but we are flexible when it comes to standards because we are going to tailor the presentation and the treatment of data, okay, based on who's going to use this information. It means that we're going to tailor our reports based on the need of the user. That's why it's called internal, or it's focused on internal reporting. While for accounting, why do we have to comply with GAAP? Because the focus is for external reporting. Now, when we say external reporting, we are referring to, reporting to BIR, Securities and Exchange Commission, or to the public. And when we say internal reporting, well, we're making reports to decision makers like the management or the owners. Now, there are different activities of a financial manager. This is also known as the different decisions a financial manager makes. First, you have the investment decisions. Second, you have the financing decisions. If our decision involves the mix of your current assets and fixed assets, or in short, okay, it has something to do with our assets, then that is an investment decision. If it has something to do with the sources of our assets, okay, then that is known as your financing decision. Now, in between investment decision and financing decision, you have your operating decision, which is not found in this slide. Operating decisions has something to do with how well you are good in using your current assets in your operations, and if this is not enough, okay, how well are you using your current liabilities, okay, to be a good source of current assets used in your operations. To summarize, what are the primary activities of a financial manager? You have your investment activities, financing activities, and you have your operating activities. Now, let's talk about the goals of the firm. Okay, earlier we have mentioned, okay, in the definition of the management, okay, achieving the goal of the firm. What is the common objective or common goal of the firm? Most of the time, okay, you will see this, okay, maximization of profits. When we say maximization of profits, okay, our main intention is simply to increase our revenues and decrease our costs. Well, it's a common objective, but this is not a good objective for a firm. Why? Because it ignores the timing of returns, which means it's possible, no? It's possible for you to have a high net income, but at the same time bankrupt. Okay, this is because of the nature of accounting, which uses the accrual basis of accounting. Also, it ignores cash flows. Okay, another one is that it doesn't recognize the risk involved in our collection and also the risk involved in the time, okay, or the timing of our revenues and expenses. We also have this one, maximize shareholders' wealth. This is actually a better goal for the firm. Why? Because it, well, under maximize shareholders' wealth, okay, it's going to consider the timing of returns, cash flows, and risks. Okay? Under maximizing shareholders wealth, it states that we only accept actions that are expected to increase share prices. Now, under corporate finance, okay, under advanced financial management, if we have time in this subject, we're going to discuss how we are going to increase, okay, the shareholders' wealth by increasing the value of your share price. Now, take note that the share price is only an indicator of shareholders' wealth. Okay? For example, let's say you decided to make an investment in a corporation whose stock is, let's say, selling for 100 pesos per share. And then after some time, because the company was able to come up with sound operating decisions, investing and financing decisions, they were able to increase, okay, the value of the stock from 100 to 120. How is that possible? Going back to the concepts of economics, if you remember your law on demand and supply, okay, for a company that performs well, okay, well, we expect that there will be higher demand for the stocks. More investors are willing to put their money on a company that is performing well. And of course, the higher the demand, the higher will be the value of a commodity. And in this case, it's also applicable to our share price. There are also other considerations, no, that you have to consider in financial management. Like, for example, EVA. EVA is a new concept. It's known as the economic value added. This is actually the after tax operating profits minus the cost of funds. In other subjects, this is known as your residual income. And there will be a separate discussion for this one in the future. As of this point, you should also know who are your stakeholders. Stakeholders are those who are willing to stake, share the risk in the entity. We are referring to long-term investors. We are referring to entities who made an investment in our bonds, okay, long-term sources of financing. Actually, any entity who is connected, okay, connected to the organization can be considered as a stakeholder. And as of this point, you should also know the role of ethics. Now, for ethics and agency issues, there's actually a separate subject for this. But as of this point, I just want to emphasize that when it comes to decision making, we want to invest, okay, in an entity, okay, given the same level of risk, no? Okay, if the level of risk is the same for all entities or for all assets, we'd like to make our investment to the one that has the higher returns. But if all of these assets, okay, will be having the same level of returns, we will be investing on the asset or the investment or the entity that has the lowest level of risk. And one of the most important roles of ethics in financial management is that this is the first line, okay, of defense against risk. This is the best way on how we can reduce the overall company risk. Now, agency issues and agency problems, okay? What are agency issues? This is when your manager is acting for themselves. Well, managers are expected to serve as agents for the entity. They should be acting, no, for the best interest of the company. But sometimes, because of self-interest, conflicts of interest, sometimes they are acting, no, their decisions are based on what is good for them. Ayun. So that's your agency issues and problems. It will always be around. Okay. There are a lot of factors affecting agency issues and problems, like for example, the cost and the benefit of a decision. Sometimes a decision can be beneficial for a manager, but not for the entity. Okay, and that will be taken care of in other subjects. Now, as part of the foundations of financial management, you have the 10 axioms of finance. Okay, what are these 10 actions? These are actually your basic framework of decision making. So let's start. The first action is known as the risk return trade off, which were already introduced earlier. Investors will not take additional risk unless they are expected to be compensated with additional return. Okay? Now, in a market or in an event wherein all investments have the same level of risk, we choose the one that has the highest return. Or if they have the same level of returns, we choose the one that has the lowest risk. But take note, this is a trade-off. Okay? In actual practice or in the industry, there's no such thing as an investment which will offer you a higher return, but compared to others, it has a lower risk. Okay, so if you are given different assets or different investments with different levels of risk and different levels of returns, well, what is normal? The higher the risk, the higher the return. So if that's the case, we should look at the trade-off. So we're going to compute, no, using statistics and economics. We're going to compute the level of risk and compute the level of return and compute the trade-off. Okay, how much risk is involved for every level of return, which is also known as your coefficient of variation. In statistics, the return most of the time is measured in terms of the expected value or the mean value, while risk, most of the time we're using your standard deviation. So we just divide the two and we get the coefficient of variation. Now another one is the time value of money. In finance, no, we expect that the value of money changes. Okay? And the money that you will be receiving today is different from the money that you will be receiving in the future. Okay, so if I ask you, what do you want? Am I going to give you 100 pesos now or 100 pesos 1 year from now? Your 100 pesos now may have a different value from that of the 100 pesos you will receive 1 year from now. So a best decision will be to get the money now. Okay, because of what? Inflation, okay, changes in the purchasing power, okay, and other factors. Next, you have your action number 3, known as the cash not profits is king. When we make decisions, most of the time, it's based on the cash basis, of recording or recognition. When we say cash basis, as introduced earlier, revenues are recorded when they are received, expenses are recorded when they are paid. Because if we are going to use the accrual basis of accounting, it's possible for us, to have a profitable business, but at the same time bankrupt. Because under the accrual basis of accounting, you can already recognize revenues which are not yet collected. Okay, so that is your third action. The fourth action is actually a favorite for consultants. Incremental cash flows. Okay, when we make decisions and analysis, we only focus on the difference. Okay, when you are going to analyze alternative courses of action, if it will result to an additional revenue, that's good. Or if it will reduce your expenses, that will be better. But then if it will increase your revenue and at the same time reduce your expenses, well, that will be a best option for us. We don't just make our decisions based on the initial value. Like for example, if you are already earning, let's say 50,000 pesos per month right now, and you are offered, let's say, a job, in another city, which pays 60,000 pesos, you don't base your decision on 50,000 or on 60,000. The decision is based on the increase of 10,000 pesos. Okay? You also have the fifth action, which is the curse of competitive markets. As, as of this point, it may not yet be relevant for you because this will be discussed in other subjects. But our take for this action number 5 is that, well, there will always be a competition and there's no absolute number one. Okay, so that's the curse of competitive markets. That's why what may be relevant now may not be relevant in the future. Okay, so that's one of our curse, especially when it comes to market analysis. Take note, we're not just talking about entities here. Okay, we may also refer to information. Okay, number six, you have efficient capital markets. Markets are quick and the prices are always right. Why? Because the value of a commodity is actually based on the information that we know. So if you're going to the market, okay, let's say your goal is to buy 1 kilo of tomatoes. So you ask, how much is 1 kilo of tomato? Okay, and then the seller would say it's 80 pesos per kilo. For you, 80 pesos might be expensive because you expect that it's only 40 kilos, no, from other sellers. But then, okay, the seller might say 80 pesos is fair. Okay, why? Because, well, these tomatoes are organic. And that information may not be available to you. So the prices are always right. It's just that transactions will only happen, okay, when there is an arm's length transaction, when the offered price is the same as the bid price. That's why in the market we are allowed to haggle, okay? And the price, no, where the sale is allowed is known as the fair market value. You also have action number seven, okay, which we already discussed earlier, the agency problem. Managers won't work for owners unless it's in their best interest. That's why we have to make the managers behave like owners. Okay, this is one of the reasons why there are a lot of modifications, no, for salaries and benefits. Okay, in PI and in Jollibee, you have these stock options where employees are given stocks so that they will not just act as employees. Instead, they're going to act and behave as owners. And because of that, their decisions, okay, will be good, no? Not only for them, but it will be good for the entire entity. Number eight, okay, one of my favorite, taxes bias business decisions. Okay, why do they bias business decisions? When we say taxes, we're not just referring to the taxes that is collected by the government. In financial management and in decision making, taxes refers to all the standard deductions that we get before we get the net cash benefit. Okay, so when we say that that profit or that income was already taxed, then in financial management, it means that all standard deductions has been removed. Like for example, not just your withholding tax, but you also have your SSS, okay, your PhilHealth, okay, your Medicare, and so on and so forth. Why does it bias business decision? Let's have an example. If you have your calculators with you, okay, maybe you can compute this. Let's say you saw a t-shirt priced at 70 pesos. For you, a t-shirt pricing priced at 70 pesos may be cheap or affordable. Okay, but let's say you are earning a salary which is taxed at 30%. Okay, which means that 70 pesos, if you're going to pay that from your salary, that is already net of 30% tax. So if you're going to gross that up, 70 pesos divided by 70%. Why 70%? It's net of 30%. So 70 pesos divided by 70% will give us 100 pesos. What does this mean? You have to earn 100 pesos just to spend 70 pesos. Now, here's a quick exercise, a side exercise for you. Okay, give yourself some time to compute. Okay, how much does this subject cost? I'm talking about our subject, which is MIT PSMO3 or Financial Management for MIT. You might include the cost of tuition fee, your miscellaneous expenses. Maybe you can also include your transportation costs if there are transportation costs, maybe your snacks and let's say internet allowances or materials that you need for your projects. Okay, you add them all. Okay, how much do you spend for one term? Now, after doing that, okay, let's assume that you belong to a 30% bracket for taxes. Let's gross that up. The total that you got earlier, you divide that by 70%. Why 70%? 100% divided by minus 30% for your tax. Okay? So once you have the total amount, divide that by 70%. The resulting figure is how much you have to earn just to spend and attend this class. Now, number 9 has something to do with risk and diversification. It states that all risk is not equal. Some risks can be diversified away and some cannot. Now, when we go to investment management, under advanced financial management, you're going to learn the concepts of diversification. Diversification is actually a process of reducing the overall risk of a portfolio. Now, when we say portfolio, this is actually a group of assets or investments. Okay? There are different ways. You have the traditional, which is um, most commonly used by investors, wherein they keep adding different types of investments or assets in their portfolio or group of assets, with the expectation that the overall risk of the portfolio will go down. Now, as the saying goes, okay, this action is actually similar to that saying, don't put all your eggs in one basket. Okay. Number 10 is the action pertaining to ethical behavior. It states that ethical behavior is doing the right thing. Okay, sorry for the explanation. I've uh, how do you call this? Yeah. It should be the right thing. And ethical dilemmas are everywhere in finance. Ayan, spelling pala. Sorry. Okay, so that's your 10 axioms of finance. Every time we make financial decisions, okay, most of the time we will be guided by these 10 axioms. Now let's talk about accounting. What is accounting? Okay, there are different definitions of accounting, but for this class, let's just refer to it as the art and science of immaapik of financial information. What's immaapik? This is identifying transactions. Okay, when we say identifying transactions, they should be recordable transactions, they should be economic or financial transactions. Okay, you should also measure them, okay, in terms of money. Okay, after measuring the transaction, you analyze the effects in our financial statements. After analyzing the effects, you accumulate the effects. Okay, and then you prepare the reports. Once the reports are prepared, we interpret and communicate them to the users so that they will be used for decision making. Now, it actually depends who the users are, whether these are external users or internal users. Most of the time, interpretation is done for internal users. Now, there are a lot of accounting principles, okay, but we are not going to discuss all of them. Okay, we're just going to discuss what is relevant as we go along. But as of this point, okay, you should know what is the accrual basis of accounting, which is already discussed earlier. In accounting, we record revenues when they are earned, not when they are collected. We record expenses when they are incurred, not when they are paid. You also have the economic entity theory. okay, which states that the business should be treated as a separate entity from that of the owner. We record transactions and make reports based on going concern basis. This means that in the absence of any symptoms or signs that the business is going to close or stop its operation, we're going to assume that they will still continue their operations for the next accounting period. Very similar to periodicity. We prepare financial statements or financial reports periodically, which means measurement and presentation, okay, should be done periodically. There's historical basis in accounting, okay, or historical cost basis, which means that the value of a transaction is measured based on its current value when the transaction, okay, was made. Okay, so if a laptop, for example, was purchased for 30,000 after 1 month, if the value went down in the market, in our financial reports, it will still be stated at 30,000. And then there should be a consistent monetary unit used in measurement. Here in the Philippines, okay, we are using pesos as our monetary unit. And in our financial reports, we cannot use pesos for some accounts, and then for some accounts we have dollars, okay, or yen. There should be consistency. Now, in our materials, there are also discussions on the basic accounting cycle. As of this point, I just want to emphasize the basic cycle, which is already introduced in our IMAAPIC earlier. First, you should be able to analyze the transaction. Okay, this is part of the identification, and then we record them using your journal entries. Once they have been journalized, we summarize them using our ledgers, also known as your T accounts. In computer science or in the field of IT, okay, you have your database. And this is the counterpart, no? This is actually the database in accounting. And then you prepare the trial balance. This is when you get the ending balance of each accounts and summarize them further by coming up with one report. Okay, and then we make the adjusting entries. What are these adjusting entries? Similar to journal entries, but the objective is not to record a transaction. The objective is to correct the balance of an account. Okay? Like, for example, if you paid rent for 1 year in advance, and let's say after 6 months you already used up, no, 6 months of that rent, okay, you have to adjust the value of your prepaid rent because under historical cost basis, it's still recorded, no, it's still recorded as a prepaid rent good for 1 year, when in fact you already used 6 months. Now, once you have made the adjusting entries, you can now prepare the adjusted trial balance. And from your adjusted trial balance, you can now prepare your financial statements. As of this point, okay, you should already know the different kinds of financial statements, which are your balance sheet, which gives us the financial position at a certain point in time. You also have the income statement, which gives us the result of operation for a given period. Okay. And also on the side, you have the cash flow statements, okay, which shows us, okay, how much cash was used, okay, in our operation, investing, and financing, and how much cash was received coming from operations, financing, and investing. So those are your three financial statements. Your balance sheet, also known as the statement of financial position, your income statement, also known as the statement of financial operation, and your statement of cash flows. Now, after preparing your financial statements, you can now close your accounts. Only your nominal accounts. When we say close them, we don't close all of them, okay? Just the accounts from your income statement. In short, it's just a matter of refreshing your accounts and putting their balances back to zero. And then you have the post-closing trial balance. What will your trial balance look like if your accounts or nominal accounts were already closed? Okay. And from there, you can already start with your new accounting period. Okay. By recording transactions. Okay. So as of this point, I will be expecting some questions once this video is posted. So please feel free to share this to your classmates, okay, and ask questions in the comments below.